Imagine you are sitting at a high-stakes poker table. Across from you are three players: Google, Amazon, and Meta. They are sweating, they are nervous, and standing right behind the table is the dealer, NVIDIA. For years, the buy and to play at this table was reasonable. You could play a hand for a few $1,000,000. It was a friendly, profitable game. But suddenly, the dealer, Jensen Huang, smiles and changes the rules. He says, guys, the minimum bet isn't $1 million anymore, it's $50 billion. And if you want to see the next card, no problem. That will be another $100 billion. If the players fold, they lose everything they have built for the last 20 years. If they call, they have to push every single chip they have into the middle of the table. And guess who rakes in all those chips? The dealer. You know that Spider-Man pointing meme? You know the one with three identical Spider-Mans standing in a circle pointing fingers at each other? Well, that is exactly what is happening in big tech right now. Google points at Amazon, Amazon points at Meta, and they are all terrified because they realize they are stuck in the exact same loop. They are screaming, I have to spend $150 billion because he is spending $150 billion. These companies aren't spending this money because they are excited about the future. They are mirroring each other's every move because the only way to survive is to build a bulletproof vest made of cash faster than the guy standing next to them. The more they spend to win the future, the more they destroy their current business model. And as an investor, you are left watching your profitable, safe tech stocks turn into cash-incinerating monsters. It feels reckless, but there is a world where this massive gamble pays off, forging a business 5 years from now that is stronger, larger, and more dominant than anything we see today. Today I am going to do a deep dive into the secret wars driving this spending, and what I plan to do with these two stocks. Full disclaimer, I am not a financial advisor. This is just my analysis of two stocks that I own. So always do your own research before investing. Alright, let's do this. Amazon and Google just reported earnings last week, and despite excellent earnings, both companies' stocks dropped by 10%. Why? Well, because they both announced that they will be spending a ton of money on CapEx to build out their AI infrastructure. Google reported they will be spending $165 to $185 billion this year, and Amazon reported a whopping $100 billion. Investors aren't happy because this money could have been going back into buybacks and dividends. To understand why Amazon and Google are tanking their own stock prices with this spending, you have to understand their relationship with NVIDIA right now. Big tech is in an abusive relationship. They are addicted to NVIDIA's chips. Every time you ask Chat the question, or generate an image, or run a cloud server, these companies have to pay a tax to Jensen Huang and NVIDIA. NVIDIA has gross margins of nearly 75%, which means for every dollar Amazon gives them, NVIDIA keeps 75 cents. That is profit that used to belong to Amazon shareholders. The big tech giants hate this. It drives them crazy. They are the most powerful companies on earth, yet they are being held hostage by a hardware vendor. So, a massive hidden chunk of this $100 billion CapEx budget is actually a war chest to kill their dependence on NVIDIA. They are building their own custom silicon. Google has the TPU, the Tensor Processing Unit. Amazon has Trainium and Inferentia. Meta has MTIA. Think of it like this. Imagine you own the most popular pizza chain in New York City. Let's call it Amazon Pizza. Business is booming, but there is a catch. You don't own the oven. You have to rent the pizza oven from a guy named Jensen, and every year Jensen doubles the rent. You can't stop making pizza, so you just keep paying him. Eventually, you realize you are working for Jensen. So what do? You stop buying Ferraris and paying dividends. You take all your profit, you spend it hiring engineers to build your own oven. It is incredibly expensive, it is risky, and it might take 5 years. But if you pull it off, you never have to pay rent again. That is what this spending is. It looks like waste today, but it is actually a desperate attempt to restore their profit margins in 2030. They are willing to suffer short-term pain to break the NVIDIA monopoly. There is also a misconception that this spending is all about consumer products. That Google is spending billions just to make Gemini slightly smarter than Chat. The real game here isn't a chatbot. It is the infrastructure of the entire global economy. Amazon and Google are, at their core, the world's landlords. Through Oz and Google Cloud, they rent digital space to everyone else. Netflix, Uber, banks, governments, hospitals, they all live on Amazon and Google servers. They are betting that in the next 10 years, Every single one of these companies will need to switch from regular computing to AI computing, and AI computing is astronomically expensive. Most companies can't afford to build a $100 million data center. They can't afford to buy 10,000 H100 GPS. Amazon is saying, don't worry, we will spend the $200 billion to build the supercomputer, you just rent it from us by the hour. This is the toll road strategy. Think about the California gold rush. Who made the sustainable money? It wasn't the people panting for gold in the river, it was the people who bought the land and built the toll road leading to the mountain. If you wanted to dig for gold, you had to pay the toll. It didn't matter if you found gold, or if you went broke, the road owner got paid either way. By building these massive data centers, Amazon and Google are cementing their status as the toll collectors of the 21st century. They are betting that AI isn't just a product, but a utility like electricity or water, and they want to own the power plant. If they are right, this $100 billion investment will yield trillions in rent over the next few decades. This scale of transformation is actually the giants setting the tone for a brand new industrial era. This kind of profound change at the logical level often requires a considerably long cycle to be fully reflected in financial performance. Facing this kind of $100 billion game, it is indeed difficult for us to grasp the true underlying pulse based solely on current fluctuations. Therefore, we have internally compiled a copy of the trillion-dollar rent-collecting empire rules to help us break down the specific flows behind these infrastructure investments. I'd have already placed this manual in the comments section. Click to claim it. Finally, we have to look at the darkest motive, the destruction of competition in Silicon Valley. There is a legend of two guys in a garage, Hewlett and Packard, Jobs and Wozniak, Page and Brin. The idea is that anyone with a brilliant idea and a few computers can topple a giant. This spending spree by Amazon and Google is designed to kill that legend forever by raising the price of admission to the AI game to $100 to $200 billion a year. These giants are building a castle wall so high that no startup can ever climb it. If you want to compete with Google search today, you don't just need better code, you need 50,000 GPS, a nuclear power source, and 3 data centers the size of football fields. That costs billions. No, the guys in the garage can afford that. These companies aren't just selling AI, they are using it. And they are seeing the future of AI from inside the machine long before the rest of the world does. Check this out. About 2 years ago, in October 2024, Google CEO Sundar Pichai revealed that more than 25% of all new code at Google was being generated by AI. By April of last year, that figure had already climbed above 30%, according to Pichai on the company's earnings call. Fast forward to last week's earnings call, and the number jumped again. CFO Anat Ashkenazi disclosed that approximately 50% of the code produced at Google is now generated by AI coding agents. 50%. That is a 5% increase in 6 months and nearly a doubling in just 10. If this rate continues, nearly all code will be generated by AI within a few years' time. Tasks that used to take a software engineer a month can now be done in a few days. And if the CEO of Google doesn't convince you, here is a tweet from Toby Luckey, founder and CEO of Shopify, from a month ago. He says he shipped more code in the last 3 weeks than in the decade before. And that AI tools in January are an entirely different thing compared to what people used. Until the beginning of December last year, this exponential efficiency with AI creates a phenomenon called operating leverage. Historically, if Amazon wanted to grow its revenue by 20%, they had to hire 20% more people. That gets expensive. But with AI, they are entering a new era where they can grow revenue by 20% or 50% while keeping headcount flat, or even lowering it if they can use AI to automate customer service, coding, and logistics. Their profit margins will explode. They are spending billions on CapEx today to build a machine that allows them to print money with almost zero labor costs tomorrow. Most importantly, they can afford this bridge. A lot of analysts compare big tech's exorbitant spending on AI to the dot-com bubble. Well, in the 90s, when telecom companies like WorldCom spent billions building the internet, they did it with a credit card. They borrowed money they didn't have, hoping profits would show up later. When the profits didn't arrive, the banks came knocking, and the companies went bust. Amazon and Google are doing something that is mathematically almost impossible. They are spending $100 billion without borrowing a dime. In 2025 alone, Amazon generated over $139 billion in operating cash flow. Google generated nearly $165 billion. Google is currently sitting on a pile of cash worth nearly $73 billion. These companies are so profitable that they can fund the largest construction project in human history entirely out of their own pockets. They aren't going to the bank. They are just opening their own wallet. This means the risk here isn't bankruptcy. It is profitability. Amazon isn't going to die, but they might spend the next 5 years making zero profit because every dollar they earn goes straight into buying chips. They are solvent, but expensive. So where does this leave you? You see the stock dropping. You see the massive spending. Do you sell? This is the hardest question in finance right now because both the bull case and the bear case are terrifyingly convincing. The bear case, the reason to sell is what we call the Microsoft dead zone. In the year 2000, Microsoft was the king of the world, but for the next 15 years, from 2000 to 2015, their stock price went absolutely nowhere. It was dead money. Why? Well, because they spent years fighting expensive wars. The fear is that Google is entering its dead zone. They will spend the next 5 years burning all their profit on data centers just to stay relevant. They might turn into a boring, low-margin utility company. If you are looking for 20% growth every year, that era might be over for now. The bull case, the reason to hold is the Standard Oil argument. You are betting that this spending works. You are betting that in 5 years, the dust will settle, and Google and Amazon will be the only two companies on Earth capable of providing intelligence. If that happens, they become the operating system of the world. Every car, every phone, every hospital, every bank will pay them a monthly subscription for their brain. The profits from that would make today's earnings look like pocket change. So, here's the verdict. If you are a trader looking for a quick pop in the next 6 to 12 months, this is a dangerous place to be. These companies are going to have ugly margins for a while. The easy money phase of the AI trade is over. But if you are a long-term investor, which I am, someone looking at 2030 or 2035, this drop might be the entry point of a lifetime. You are buying a monopoly that is currently building the most valuable infrastructure in human history. It is painful to watch the construction, but the rent checks they collect on the other side could be enormous. The suicide pact is scary, but usually, the guy with the deepest pockets survives the standoff, and nobody has deeper pockets than these two. So, what do you think? Let me know what you think in the comments below. My guess is there will be some opinions on both sides, which is fair because it's not an easy call to make. Thanks for watching, and I will see you in the next one. The giants are using their massive cash flow reserves for a gamble on monopoly power over the next decade, and the results of this gamble will directly determine whether they fall into long-term stock price stagnation or evolve into unprecedented global smart infrastructure monopolists. To facilitate a clearer reference dimension in our observations, we have internally compiled a copy of the $1 Trillion Rent-Collecting Empire Rules to provide us with a more systematic review. Perspective. I'd have already placed this manual in the comments section. Click to claim it.